Texas. Well, this is a company that we have looked at for a number of years. It's appeared in our Canadian small cap to mid cap cash rich report. It's typically had a solid balance sheet and reasonable growth. And we'll look into strong revenue growth historically, but has the profitability been there? And that's kind of going to be the crux of what we're going to look at today. Texas trades around $28, $414 million market cap. The company is based in Montreal. They're a provider of supply chain software solutions for the healthcare and complex distribution verticals. The company's software covers warehouse management, distribution, transportation management, supply management, at point of use, distributed order management, along with financial management and analytics. They primarily sell its solutions on a SaaS basis, or software as a service. They have over 1,000 customers in 15 countries. Now, let's take a look quickly here at the recent numbers. This is Q1 fiscal 2024, so the first quarter of the fiscal year. Revenues rose 21.7% to about $41.9 million. SaaS revenues were up 44%. Of that revenue, they were 11.5%. Adjusted EBITDA was $3.2 million. That's up 114%. And earnings per share were 8 cents, from basically flat in the same period of last year. Now, Texas exited the quarter with a solid balance sheet, net cash of $31.9 billion. So again, the balance sheet is strong. Let's look at their guidance, because you're always looking forward when you're trying to value a stock. Texas, they're reiterating their previously presented fiscal guidance for 2024. 2024 revenue, 10 to 15%. Revenue growth, 35. No, sorry, that is SaaS revenue growth. The revenue growth overall, 35. The SaaS revenue growth, sorry, is 35 to 37%. And the adjusted EBITDA margin right now, 6%. They don't have any guidance in terms of total revenue for fiscal 2025 or SaaS revenue growth for 2025. They are stating that adjusted EBITDA margin for 2025 will be 8 to 9%. Now, the revenue growth is decent. The midpoint there is 12.5%. And the SaaS growth at 35 to 37% is strong, but it implies a slowing throughout the year, as Q1 came in at 44%, and the SaaS revenues still remain under 30% of total revenues. Now, the adjusted EBITDA margin is 6% here, is low. Even moving to fiscal year 2025, it's moving in the right direction, up to 8 to 9%, but it is still a low number, particularly for a software-driven company. So let's look at the valuations right now. Currently, they're premium with a trailing EV to EBITDA of 38.84, price to cash flow of 68.2, and a PE of 125. On a forward-looking basis, EV to EBITDA 33.2 times, the PE is 88.8 times. Again, these are lower as we see growth going forward, but they're still high across the board for a company looking at total revenue growth in the range of 12.5%. Of course, the SaaS growth is higher in the 35% range, but the total revenue base of the company is still just expected to grow 12.5%. So our take here, Texas is a solid software success story. It's grown its revenues. You can see here in US dollars over the past 10 years, from 2014, where they were 41.1 million, to the last 12 months at 121.5 million. So that's good growth. Operating income has been more volatile over that 10-year period. To be frank, operating earnings, cash flow, and adjusted EBITDA margins are quite low. This is partially due to the fact that while its SaaS offering is growing, again, it remains under 30% of the business. There's hardware and service revenue making up the majority of the revenues. Hardware in particular can be lower margin. The company also continues to spend to take advantage of what it believes is a large and underserved market opportunity. The strategy has grown sales smartly, as we've seen, to the point where it trades at a price to sales of roughly 2.5 on a trailing basis, compared to its peers in the range of 3. But it's led to profitability that's been volatile over the past decade. Texas has a strong track record of revenue growth, a strong balance sheet, and the normalization in the supply chains in the retail and logistics sectors should enable its end markets to begin to focus on improvements, and such as Texas's solutions. However, the company's profit margins and valuations at present make it too rich for our models, and we continue to just monitor. the stock right now.
Yeah, like you said, we've that's just disclosures.
Yeah.
Like you said before, we've looked at it many times, have had it in our cash report or our Canadian cash rich reports. Um, I'm looking at a report that I wrote April of 2022. The price was slightly higher. Again, it was just a monitor in that report. And again, April of 2022, EV to EBITDA multiple 39 times. Trailing price to earnings multiple still 124 times. So, we really haven't seen much change in that valuation at all.
Yeah, well, I guess we can say it historically just trades at that, so it'll trade at that forever. But I mean, the expectation is for further growth going forward, and at some point in underlying cash flow on a per share basis has to pick up to really drive the stock forward.
Mm-hmm.
Like we said, many of these mid-size to smaller cap related software as a service or just software related companies are still cut in half from their kind of crazy pandemic highs. So the question came in, is this a great value now? Well, as you can see, it was at insane valuations in the pandemic. Right now, there's still significant premium valuations. If they can keep growing that SaaS business at 35+%, that, it then becomes intriguing. And they are, servicing the supply chain is a great area to be in right now. It should be, it's kind of, like I said, it was tough to probably sell into it because anybody in that department was likely just fighting for their lives over the past couple of years. Now they probably think we need to optimize our solutions. So you may, they believe, and reading through their MD&A, it looks like they believe, there should be a great backlog going forward of business, and it's a great pipeline that they can sell into. So if they accelerate growth, or at least keep that SaaS revenue growth at revenue growth in the SaaS business 35+%, you can justify maybe an EV to EBITDA that is 35, 38, but they have to continue that or maybe even accelerate that. And then it would become somewhat more interesting.
It's
but
quite
also
low
just
margin
converting
for
some
a
of the cash.
software company. I mean,
Yeah,
6%, even their target of 8-9% for EBITDA margin. I mean, that's quite a low margin for a software company.
Yeah. I think the justification to some degree is to spend a large market. There's a huge opportunity right now, but at some point you have to go higher, right? You have to get a higher margin for us to really be interested, because we have to believe that you're able to do that going forward. And again, the specific SaaS part is still under 30% of the business. So, we'd love to see that 50% plus and continue to grow. It's growing at a good rate, so it could get there in the next 3 to 5 years, but we'll see. So stock will continue to monitor, and I think it's done well as a really good Canadian success story. But it trades at premium valuations now.